Unrivaled Nation. This is part 2 in the series on where are we in the market and what can you potentially do about it. So the first part was a sort of a stock market commentary based on sort of the signposts that we've seen over the last few weeks and months, suggesting that on this stock market journey, on this financial journey, we're probably closer to a top than to a bottom. Potentially even days before the cycle peaks, where there could be a dramatic amount of downside. So that was sort of one. So that's what a lot of the sort of signposts or data that, looking at where we are on the journey sort of lead to. Now, it's not definitive. Crazy can go on for longer than expected. So that's why I wanted to do this episode. This one is supposed to be more of a timeless episode, whereas the first one's more focused on sort of a timestamp. Where are we as of January 24th, 2020? This one's more of a educational video on how to think about hedging. What to do that's right for your portfolio. And this is based on sort of my initial thoughts. This video really is an outline where I'm going to be going through a lot of my thoughts on hedging. And if I have more thoughts on it later on, I'll add to it. But for now, these are sort of my key thoughts on hedging, and we'll get into it. So, what do we see when we look at this? Broader context for hedging, a few disclaimers and warnings. What's the most important thing? Why and what is hedging? What's the most important thing is sort of like, well, wait a second, what are we actually trying to do here? When do you hedge? Do you use valuation? Do you use price action? What do I hedge with? And this is personally updates and payouts in terms of journey updates and portfolio framework, how to think about your portfolio, as well as big flaws with hedging. So I'm going to go over all these points, but I just wanted to show you just from a sort of a table of contents for this video of what I'm planning on talking about in the ensuing minutes, as we discuss hedging. So let me make myself full camera here. So now let's go over the full, what am I actually looking to cover? So first, as I already mentioned, stock market, no one knows exactly where it goes. That'll be the same as the past or as the future. You never know precisely, does it go up? Does it go down? Now you can get sort of ballpark signatures along the way of, hey, there's some of these data points that I should be thinking about. So that's the broader context of, I'm making this video in the context that there were a lot of data points suggesting that we're closer to a peak in the cycle than at the bottom. It's guesswork to say, hey, we're there. And so what are you going to do about it? That's what this video is about. So when I think about as a disclaimer with hedging, first one should understand that I view hedging as a completely different exercise than what I do with the vast majority of my portfolio. Like 98% of the time, I don't want to be focused on hedges. I don't want to be focused on, what's the S&P 500 doing. I don't want to focus on hedges. What I really enjoy is diving into companies. That's where I want to spend my focus. And so that's where 98% of my focus is on, is trying to find the next unrivaled investment. And one should view this sort of as a distraction or a sideshow from the main focus, which is trying to find these companies that I could feel comfortable owning for years at a time, that'll compound at a more than satisfactory rate over time. But I also do hedge, as it's part of my temperament. But it needs to be understood that hedging may not be suitable for your temperament. It may not be suitable for your journey. And as always, none of this is advice. I'm not saying, hey, go buy this stock. I'm sharing what I buy. And if you deem that it's appropriate for your journey, you do that yourself. Now, the question is like, well, what's the most important thing? Like, let's get back to basics. What are we actually trying to do with investing? And the reality is, a lot of people lose sight of this, particularly in bubblicious times like we're living in right now. But the number one priority you need to always have in your mind, no matter what type of market you're in, is the number one priority. Number one priority is just not blowing up. So, and how do you not blow up? It reminds me of the study of Peter Lynch, who was a famous investor, and how the vast majority of the folks that invested in his fund actually had significantly subpar returns, because they would put their money in with him when he was doing really well, and they'd pull the money out when he was doing poorly. And so they'd constantly sort of whiplash themselves based on his recent performance. So the reason why I bring that up is that, and so those investors were effectively blowing up their own returns by doing that, because ultimately if you had just bought and held through Peter Lynch's time as a mutual fund manager, you would have done really well. Whereas if you think you're going to time someone and you're going to do it based on how they're doing, and you're buying when he's done well and selling when he's done poorly, that results in a much worse performance. The point that I'm trying to say is you need to stick to something where you feel like you'll be consistent at it. So you'll be you won't be panicking at the lows and saying, I got to get out of here. And that literally happens. I mean, that's how stock market lows happen. That's also how stock market highs happen, where it's just like, I need to have this. It's the fear of missing out that leads to that top tick, that greed. So I would focus on like if blowing up is the top, if blowing up is the top thing you need to avoid. So investing is about not blowing up. You need to find something that you can be consistent at, so you will not blow up along that cycle, recognizing that there will be highs that tempt you to buy, and there will be lows that will tempt you to sell. But you need to recognize that's part of the journey. So find something that fits your temperament, and that's a really important caveat when it comes to hedging, because I think hedging sort of fits my temperament. Definitely may not fit yours. And when I mean consistency, like it's worth, once again, I'm enjoying reading Morgan Housel's book, The Psychology of Money, where one of the points he makes, and look, nothing that's going to change the universe here, but it is a good point of, something like 95% plus of Warren Buffett's wealth has accumulated after he was like 65 years old. So the point is that it's a steady process, and it's the power of compounding. So tens of billions of dollars, the vast majority of his wealth, one of the wealthiest persons alive, Warren Buffett, the vast majority of his wealth has occurred after he was 65 years old. So you gotta let this process be, you gotta have consistency, you gotta make sure you don't blow up. And that's why it's so important to find something that you can stick with. So if you're like, hey, I'm only gonna short at these points, but I'm not going to do it then, or I'm going to hedge, but I'm not going to do it these other times. You really need to think about, well, what's a process that I could stick to, through thick and thin. Just like, when you're thinking about Warren Buffett, he stuck to a process that he could stick to, and that was his process. Honestly, in my opinion, is just like stone cold rationality, and that's he's in my opinion, he gets as close to Spock as you can get when you're thinking about investing. It's just like stone cold rationality and avoiding things where he could blow up. That's like Buffett in a nutshell. Like, hey, what's the odds this business is still doing this type of business 5-10 years from now? What's the odds that it's bigger? Okay, not going to blow up, I'll invest. I mean, that is sort of like the stone cold rationality that he exudes and follows. And it's been a consistent process. He hasn't tried, I'm going to do tech stocks now. I'm going to do swing trading. I'm going to do SPACs. It's like, hey, I'm just going to buy shares in companies that I understand and can compound at a good rate over time. Okay, so why and what is hedging? So let me get into that. So hedging, to understand what to hedge is, it's effectively to give your portfolio something that'll gain in value, ideally, if other aspects of your portfolio start falling. So let's say if the stock market starts falling and your portfolio is heavily, similar to the stock market, or let's say the S&P 500 index, which is a basket of 500 largest companies in the United States. If that basket were to start falling, do you have something that will offset it? Do you have something else where you'll be making money from that? And that's hedging in general. The way I think of hedging personally, like as I apply it, is, and a lot of people won't like this, but I think of it as dark arts, in all honesty. It's more sizing up sort of animal spirits, sizing up people, looking at all these data points, similar data points to what I did in the first part of the video, sort of figuring out where you are. It's not precise. It's also unlike stock and picking stocks, where you could see sort of my portfolio, and in all honesty, my batting average is pretty good in terms of the win-loss ratio there. When I look at hedges, the win-loss ratio there is terrible. So you need to understand, like for me at least, it's not an area where it's like, hey, 9 out of 10 times or 7 out of 10 times you feel like you're buying a company, like where you're going to win in a scenario. I don't feel like that's with hedging. Hedging, the win-loss ratio is way worse. And most studies, in terms of most favorable that you can find on hedging, show that it effectively is neutral to your portfolio. So at this point, you're sort of saying, well, why do this if hedging is at most neutral to your portfolio? Like maybe it adds a little bit, or maybe it subtracts a little bit from your portfolio over time. If it's just neutral, why would you want to do hedging where you're effectively betting against something for your portfolio for when times are tough? And the reality is the main value of hedging is that it protects against significant drawdowns. And so that's part of what I mean by dark arts, is sort of saying, well, where are we in this market cycle? Are we closer to a point where we could have dramatic drawdowns? Do I feel like I'm going to start needing that hedge protection? So that's sort of what I'm talking about here, which is that it's not necessarily a meaningful contributor over in one given year or 2 years, or even over a multi-year period. It might just detract from your returns by a little bit. It might just incrementally add a little bit, but it's not going to be a game changer. Where it will be a game changer, where it does add value, is that it helps, and this is what the studies suggest, is that it helps in protecting on the downside during a significant drawdown. So if you start putting hedges in place and the market has a significant drawdown, your portfolio won't go down as much if you have those hedges in place. And then, depending on how opportunistic you are, you could unwind those hedges, close them up, and now you have the profits from those hedges, and you can then deploy them into what is supposed to be attractive opportunities. So if you have a bunch of hedges and the stock market drops 50%, you can now take the profits from those hedges and plow it into what you think are cheap stocks, and then get sort of this amplified upside when things start to recover. So that's how I personally think about hedges. So when do I hedge? At what point do you hedge on valuation, for example? A lot of people have been, you can look at those charts, you could look at a chart where you see, oh my goodness, the CAPE ratio has never been this high. And I talked about the CAPE ratio and where are we, market commentary. So like, do you short when things are just expensive, or when you're starting to reach a new expensive, valuation ratio? And honestly, it's too hard to short just based on valuation. If you're shorting just on valuation, it is an extremely painful process and ride, because things can start off as mildly expensive and you're like, okay, I'm shorting. And then it can go to pretty expensive, and then expensive, then very expensive, then crazy expensive, then just bananas. And that can go on for years. So I would argue hedging based on valuation is extremely tough, and extremely is a good way to make yourself poor if you focus just on hedging based on valuation. That is just something to keep in mind. So how are you going to hedge if valuation isn't actually the thing for when you do hedge? What do you hedge on? And that's where you start leaning into this dark arts, because valuation is something where you can sort of use stone cold logic to sort of say, well, what's your profit margins? What's the market cap of this company? What's the earnings power? What's the valuation? That is closer to stone cold logic. Whereas, the when do you do it? This is starting to get into the dark arts territory, where I'd argue, and what I personally follow with hedging, is to start looking at price action. So what do I mean by price action? And this, once again, this is sort of dark arts, which is that it's based on several different variables of the market when I'm looking at price action. So I might be looking at, what are these different sectors in the market doing? Because certain sectors perform differently at different parts of the cycle. I might be looking at market breadth. So like, for example, how many stocks, what percentage of stocks are performing above their long-term average? What percentage are below their long-term average? Because, you might start seeing interesting divergences. And you can look at the historic data that's interesting here, where you could see the market in the past cycle peaks. For example, in 2006 and 2000, where the S&P 500, let's say, was making new highs while the breadth of the market was continuing to decline. And so when you see something like that where fewer and fewer names are actually upholding the market, it does create this risk like, oh man, actually most companies are now in a downtrend or below their average price over, let's say, the last 12 months. There's an increasing odds that this thing starts to turn over. So you see things like that. Another sort of dark arts aspect, and that's what I mean. It's not like a definitive like this company is cheap, which is a lot easier for me to think about. Like, is this unrivaled? Does this have a good valuation? Does this have 10x potential? And if all of those are yes, like, hey, this is cheap, it's unrivaled, and has 10x potential, then I'm probably like, yes, I'm going to invest in it. I don't know if it's going to be 10% or 1%, but I'll probably be investing in it. Whereas here with hedging, as you can tell, when I say dark arts, I'm sort of saying like there's a lot of things that are sort of squishy to it, where it's like, well, what's the market breadth? What are credit spreads doing? Credit spreads show you what's sort of the risk tolerance that fixed income investors have against the treasuries. So if let's say corporate bonds are priced at 5% and treasuries are priced at 3%, then the spread is 2%. But then you might see overnight that corporate spreads go to 6%. So now, the corporates are at 6%, the treasuries are at 2%, now it's a 4, now it's like a 4% spread. So you're like, what's going on here? That the treasuries have, the yields have gone up, but corporates, the yield has gone, so the treasuries has gone down, yields on the corporates have gone up. You're like, why is this spread widening? Well, that reflects a risk tolerance change. Well, if all of a sudden people are finding generally supporting corporate fixed income as riskier versus, let's say, treasuries, then it might be reflecting this sort of risk change, this change in risk preferences from, hey, I'm willing to buy anything, to, hey, I'm not willing to buy anything, which is a big difference. So I look at market breadth, I'm looking at corporates, I'm looking at credit spreads, I'm also looking at moving averages, sort of the long-term trends of how this company or how this index has performed. Usually with hedging, I'm primarily looking at indices, and I'll talk about that in a minute. Of saying, well, what's actually been going on over the last 6 months, 12 months, 3 months, 10 days, looking at multiple different frameworks of, is it, over the last 12 months, has it been trending in a favorable direction, or is it actually declining relative to where it was over the last 12 months? So there's a lot of different angles in which one can look at sort of this price action to start sizing up, hey, should I have more hedges in place? So you can start with valuation, but that is not by no means like a binary switch. And then you start layering on different things like, well, what's the recent price action? Did it go below, let's say, a 10-day moving average? Or, what have credit spreads said? Or what is the market breadth saying? So there's a lot of different elements, but I don't, unlike stocks where I can definitively say if it's cheap, if it's unrivaled, and it has 10x potential, that I'll be investing, I can't definitively tell you, oh yeah, this is the setup for hedging. With hedging, it's much fluffier. It's a dark art aspect where you're sort of sizing up, sort of a mosaic. It goes back to that first video on where are we. You don't know exactly where you are. You don't know if you're at that peak in the cycle or if it just keeps going, keeps going. And so you want to just sort of feel around and not overcommit to something. So what do I hedge with? And so first of all, like, do I hedge with stocks? Do I short stocks? And I think, this video, I'm making it today as GameStop stock is up another 100% plus. It's been a short squeeze. So I think that's a perfect example of why I actually don't short stocks, just because the blow up risk it's asymmetrical at the end of the day, is that a stock can go up dramatically. It can go up literally hundreds or thousands of percent, whereas shorting, you only have that 100% upside, as it can go down 100%. So I don't short stocks. If I were to short stocks, or if I wanted to bet against stocks, I would buy a put. Put gives you the right to effectively sell a stock at a fixed price. So I'm not selling calls and I'm not selling puts. I want to be anti-fragile. I want to benefit from the volatility of the markets. I'm not looking to be, sort of held over the edge, be pressured by what the market does. And so with hedging, I will not be shorting stocks. If anything, I would consider buying puts. I prefer, however, not to use options such as buying puts. I like them a lot less than what I'm about to talk about, what I actually do short. I generally don't like options because as retail investors, you're generally getting suckers bets because the market makers are setting a really wide spread between what you can effectively buy these at and what you can sell these at. And it's such a wide spread. They're doing that so that they can make money as a market maker and for the risk that they're taking on. But overall, it's a lot less liquid to use options, and there's oftentimes a huge premium baked into it, such as volatility or time, that it's hard to make just incredible returns. And the options that retail investors have generally aren't that great. This isn't like Dr. Michael Burry from The Big Short, where he could, short this housing subprime basket and make 100, 400 times his money. Most of the time with stocks, particularly with puts, the amount of money you can make, it's like, yeah, if the stock falls by 50%, you can make 3 times your money. And if the stock doesn't fall by 50%, you lose whatever money you bought in those puts. So that type of asymmetry is not good at all. So I much prefer something where it's much better. So what do I actually short, and how do I hedge? In particular, how do I hedge? And so I actually prefer hedging with using ETFs or using a basket of stocks, so that way you don't have this blow up risk of, hey, this is being short squeezed and can just go up exponentially. Where I generally short various different ETF products. If you see my monthly holdings, you can see which of the ETFs I've recently done. Where I sleep better at night in terms of that risk of like, hey, could this pricing get out of whack? Because as the market makers, they can either create more units or buy in the existing units if you start getting a price discrepancy between what is the value of those units versus its underlying assets. So you're not going to get, the S&P 500 is not going to go, up 100% overnight like GameStop. The S&P 500, maybe you're talking 5% on a crazy day. You're not going to get that sort of rip your face off volatility that you can get with individual stocks. So as a hedging approach, I generally prefer shorting ETFs that track a major indices. So I will short some of the ETFs. I could short like an S&P straight up, or if you want to start getting fancy, you can start shorting some of the levered ETFs, partly because those levered ETFs, so shorting like the 2x S&P or shorting the 3x S&P, partly because longer term, those levered products will actually result in effectively those ETFs will wipe themselves out over time. And the structural way to think about that is, if you have, this is an example, it's not perfect, but if you have, let's say, a 30% drop in one day, then these very same ETFs will lose 90% of their value. And if you have a subsequent 30% rally, now that doesn't get you back to the former recovery, that only gets you let's say about 100% price recovery. But if you've gone and you've already lost 90% of your value, and then you bounce, so you go from $1, if you go from $1 to 10 cents, and then you double from 10 cents to 20 cents, you've still lost 80% of your value. So that's why I'm more inclined to short the leveraged ETFs, whether or not it's 2 times or 3 times. Depends on your risk comfort and sort of the volatility you want to take. You can also consider tax purposes for that. So I generally prefer shorting those ETFs, for the reason that it's a way of shorting stock exposure while also not having that sort of exponential risk that you can have with a short squeeze like we currently see with GameStop. Would I consider buying things like a reverse index ETF? I prefer to avoid those altogether. At the end of the day, those products were made to effectively get people to trade. And their history over time is that they don't do very well at all. And I would rather buy puts personally. Like, so for a retirement account, I'm more likely to buy a put than I would buy one of these reverse ETFs that are supposed to increase in value if the market declines. Just because I generally don't like the way those reverse index ETFs are structured and how they perform over time. I generally find that what's the nicest way to say crappy? That's what I think. Where it's not a very attractive risk reward and they just don't perform. So in terms of, I've given an indication of when do I do it, which is based on price action, which is sort of nebulous. It's focused on multiple components. It's focused partly on valuation, but focused primarily on, does the price action support this? Where I will sort of, once again, 98% of my time is focused on individual companies, but that other 1-2% is like, should I be hedging right now? And I'm not like, oh my gosh, I need to be day trading this. No. Like, if I'm going that way in life, it's not a productive use of my time. I'd rather find a company that can be, up 20, 30x over time. So with hedging, it's more like, let's just check how the market's doing at the open, check how the market's doing at the close. If the price action continues to be weak, then and I'm seeing these other indicators suggesting that, it should roll over, then I'll be putting on my hedges. Then I'll be increasing my hedges. So I recognize that a lot of this is nebulous, but that's because I don't think hedging is a high, first of all, I don't want to. I'm really hesitant to even give updates on when I hedge, just because like I'll be tweaking I might tweak it like at the end of the day and say, you know what, let's just throw 0.5% hedge on there. And then a week later or a few days later, price action's not favorable, I'll blow out of it. And so it's very minor. It's something I check out at the end of the day, see how the market action's doing, and if I don't like it, I don't like it. Whereas, and I don't want to, that win-loss ratio, I don't want to, spam, you with, these little sort of incremental updates that don't really mean much to the portfolio. So, and that gets to my promise to you, Journey subscribers, that I will share the material changes, of when there's a big change in the portfolio, like, hey, now I'm 5%, now I've put down a 5% short position, or now I've put down a 10%, or now I've got a 20% short position. So those bigger updates, I'll definitely let you know. I won't be saying, oh, this trigger was happening. Like, a lot of it is dark arts where it's feel based on the things I'm seeing. It's not, very cold logic like the stocks that I'm trying, the compounders, the unrivaled investments that I'm trying to find. But yeah, so I as always though, I will give a monthly update of everything that I have. But in terms of, I will only update the hedges when it's been a material change. And then here's another core concept of like portfolio framework. How do you think about investing? How do you think about the portfolio? And I think this is just such an important concept for you to consider with your portfolio, which is that you don't always have to be 100% invested. It's okay to have a range of exposure. And so this is where the words gross and net exposure are so important to think about. So if you're 100% invested in stocks, your gross exposure is 100% to stocks. Now, if you, let's say, put on a 10% short S&P 500 hedge, then your exposure, you still have 100% gross, but your net exposure is now 90%. Now, what if you hedge and you're shorting a 3x S&P 500 ETF, and that's 10% of your portfolio? If that's the case, your gross exposure has gone from 100% to effectively 70% net exposure. So I would always be thinking, when it comes to your investments, what's my gross and what's my net exposure? Now that's only if you really want to be getting into this game of hedging and how do you want to think about it. Honestly, I feel like for most investors on their personal journey, they would be better off saying, hey, I'm I'm going to be investing this long term. I recognize that there will be market cycles. And for most people, it's probably best to avoid hedging, just given that, like, oh, am I doing it now? Oh, yeah, I'm going to get whiplash. I'm going to be losing money in a lot of years where I'm doing this hedging. So honestly, for most people, it's probably not appropriate for their journey, for their personal journey. For me personally, I don't mind the whiplash. I'm psychologically wired to accept, like, hey, this is a strategy where 9 out of 10 times I'm probably going to lose money. And that's okay. And that 10th time, it might prevent a huge drawdown, and I'll be happy about it. And if that means net overall, it's effectively neutral to my portfolio, so be it. But psychologically, I like doing it. Maybe at some point in the future I change, but at this point, I'm very comfortable with it. So when you're considering a portfolio, if you're not thinking about hedging, you can still do this gross and net aspect by thinking about your cash allocation. So you could say, let's say, your portfolio is $100,000. If that's your portfolio, and you're like, well, wait a second, $30,000 is in cash. So your gross exposure, that the other $70,000 is in stocks. Your gross exposure is 70%, where 30% is in cash. So that's some ways to think about it. Then you can start thinking, well, if you buy put options, then that might lower your gross exposure a little bit based on what the notional value of those puts are. So that's a critical framework to think about. As you get closer and closer to saying, hey, I want to be, if let's say it's red alert and I'm like, these hedges, I definitely want maximum hedging right now. When I'm thinking that, then it's really about, okay, I want to bring my gross exposure, I want to bring my net exposure to as low as possible. So I might be 70% gross invested or 100% gross invested, but I will want hedges that will offset a lot of that. So, right now I'm about 70% gross invested, 70-80% gross invested. I might, maximum hedging, I might want 80% hedges, effectively bringing my net to zero. Now that could be really expensive if the market rips higher and those hedges, eat up my returns. But that's just something that's part of the game. So that's something you have to think about in terms of what net exposure do you want. If you want to be maximally hedged at a point, what's that net exposure? Is it 30%? Is it 50%? Is it 70%? Where is the range of net exposure that you want to consider? So what are the big flaws with hedging? There's actually a lot of flaws with hedging. One of which is that, it's arguably tax inefficient at times, where you short this vehicle, and then, shorting is inherently going to be short-term tax gains, and then, you might have to reshort the same product if, same ETF, less than 30 days later if you're following, hey, I'm just shorting this ETF. Another problem with shorting is that, it's not like it's driving this huge incremental value to your portfolio most years. Most years, it's probably going to detract from your returns. So I'd argue like it's inherently not sustainable for most people because you're not getting that dopamine hit of like, hey, you made money from this. So for most people, it's not sustainable. And if it's not sustainable, does that mean they just try hedging once or twice and then they've lose both times, and then that seventh time when they would have been doing it, it would have made up for all those losses? So that's the challenging part with it. And I would say another one of the chief flaws with it, particularly this hedging strategy, and this is the one where I could be just dramatically wrong on this, and it would be unfortunate if this happened, was that my hedging strategy is largely based on, as I indicated earlier, it's largely based on price action. Has price action started turning unfavorable, suggesting that I could start layering on this hedge, especially if you already have the overlay of this is an expensive market. I'm seeing these other data points like market breadth or credit spreads starting to turn. Am I seeing price action? Maybe it's the 10-day moving average. Maybe it's the 200-day moving. You cross below the 200-day moving average. Am I seeing price action that warrants hedging? And the biggest risk to this process, in my opinion, is that what if there's an overnight black swan event that was not sort of telegraphed with the price action? So let's say you had strong price action in the last few days, and then just a horrific black swan event happened somewhere in the world, and the market does not open for the next week. And then indications of when it opens is that it's down 30 to 40%. And there's a lot of possibilities for what these types of black swan events could be. Like imagine if one of the major banks of the world got hacked and all those bank accounts were compromised. Like what sort of havoc that would cause. Imagine, biological or nuclear terrorism, something like that, where it's just like, oh my gosh. So you can have an event where the market arguably opens materially lower and it was not preceded by unfavorable price action. So that is I would argue, the huge flaw with this hedging approach, which is that it will not truly capture those black swan events if the price action immediately prior to it was favorable. The flip side is that, like, if the price action was unfavorable, and I don't know how much of this was luck or what, but you can look at several tragic events where the market was shut down, and you'll see that price action generally was unfavorable leading up to it. So you could see that sort of throughout the last few decades, is by and large using some sort of price action metric of a 200-day moving average as a very basic method of when do I hedge. And I personally use that as one consideration of the 200-day moving average when I'm thinking about hedging. And when I look at that, that approach has actually done fairly well, at least based on the studies of just a super basic hedging approach, 200-day moving average. I'll actually drop a link to that in this post, because there was a study done by Meb Faber where he said, look, use a super basic 200-day moving average and it'll barely incrementally improve your returns, but where it really helps is on the drawdowns. So there's different ways to do it. From how I approach hedging is that I'll start with, let's say, I'll start with a short-term hedge of, like, is the very short-term price action turning unfavorable on the market, and is the market generally expensive? And if that's the case, then I might start a very preliminary hedge. That might be a couple percent. And then if you start falling apart and you're below, let's say, the 200 moving day, the 200-day moving average, then I'd say, okay, now we're getting probably closer to a much bigger short allocation. And so, you start thinking about, okay, where are we along the lines here? Where are we going in terms of, how far this has fallen? Has it fallen dramatically and then recovered back to the 200-day moving average, but it still looks like it's starting to fall apart? So that's part of what I mean by dark arts, is like, I don't want to spend a lot of time doing this, because I think most of the value that I will create for my own personal journey will be finding these compounders. But every day around the market close, spend 15 minutes, see where we're at, and based on that, try to size up whether or not I want to do more hedging. And that's, I think this covers the broad thoughts on hedging. It covers what I hedge, when I hedge, why I hedge, the pros and cons of which. It's and recognize it is fairly nebulous. I don't have that super strong, like, yes, this is super clear cut that you should be hedging here and not there. That's not the case. There's going to be a lot of whipsaw back and forth, like, oh my gosh, I completely got that wrong. This is not like buying into unrivaled investments, in my opinion. And yeah, so that's really it. I mean, I can't think of really anything else with hedges, but feel free to leave a note below in this video if you have some additional questions, and I can always make an incremental video. But I think this covers it. I'm focused on shorting ETFs versus individual stocks. I don't want to buy those reverse index ETFs. I consider a multitude of things when I'm hedging. Hedging is a distraction relative to my main endeavor. I hedge because I'm looking for some protection against a major drawdown, and I psychologically like it. It's a little bit of action, but honestly, it's a 2% distraction versus the 98% focus on long-term compounding. I hope this video has been helpful for you in terms of thinking about hedging for your own portfolio. If you think it's appropriate for your own journey, for your own journey, I personally think that hedging is not appropriate for most people's journeys, just because the psychological whiplash alone would throw most people out, where you lose, and then you're like, screw it, I'm not doing it again. And then, you know, a few indications later, you would have actually made money. So that's the reason why I actually don't advise. You know, I first of all, I'm no advice here, but that's one of the main reasons why I don't think people would like it. And I hope this has been helpful. Thank you so much for watching. Thank you so much for subscribing.